It's the special edition of Business Incorporated. Thank you for joining us. I'm Chimeze Obi Iwago. The Monetary Policy Committee of the Central Bank of Nigeria has been deliberating monetary policy direction for the next 2 months, with the Central Bank Governor Godwin Emefiele set to announce its decision shortly. Now, this is the last meeting of the committee for the year, and it's coming amid fears of escalating tensions arising from the spread of COVID-19. A second wave of COVID-19 is recorded across major economies. However, promising developments on the vaccine front have sparked optimism that the pandemic's end may be in sight. Massachusetts-based biotech company Moderna said last week that its coronavirus vaccine was nearly 95% effective at preventing COVID-19. That news came a week after US-based Pfizer and Germany's BioNTech revealed similar positive results from trials of their own vaccine. And just yesterday, that's Monday, British pharmaceutical giant AstraZeneca said an interim analysis of clinical trials showed its coronavirus vaccine has an average efficacy of 70% in protecting against the virus. But if the market trends that immediately followed positive vaccine news are any indication, some sectors will benefit a lot more than others. But let's look at how the European stocks are doing this Tuesday amid growing optimism that another effective coronavirus vaccine has been discovered, and on news that the Trump administration has accepted President-elect Joe Biden's transition into office. And of course, the choice of Janet Yellen to become the country's first female Treasury Secretary. Let's bring in my colleague in Frankfurt, Ashutosh Pandey, to bunch all of these for us. Well, Ashutosh, I'm so sorry. Good afternoon. I'm sorry I have to cut short your time on the show. It's our MPC decision day, and we have a whole lot on that. But how are markets in Europe reacting to the developments stateside, particularly the expected naming of former Federal Reserve Chairwoman Janet Yellen to become the next Treasury Secretary? That's a face investors are familiar with, isn't it?
Yeah, absolutely, Chimi. And that's the reason why the markets have been reacting favorably. It's a face they know. I mean, she's a known policy dove, somebody who cares a lot about creating jobs, and her expertise and her passion would be needed at this point of time when the pandemic has actually led to millions of job losses. And she's also somebody who is seen who people expect will work very well with the Fed chairman, Jerome Powell. Recently, we've seen that the relations between the Treasury Secretary, Steve Mnuchin, and the Federal Reserve haven't been at the best. They had a public spat last week itself when the Treasury Secretary actually ended some of the emergency financing facilities that were there at the Fed Reserve. And so we can expect that this kind of a spat is not going to happen when Yellen is going to be at the forefront. But her task is actually cut out, and she needs to actually end the logjam in the Congress and ensure that a fiscal stimulus is provided as early as possible. That's going to be her first challenge. And you mentioned the transition there. That again is a major positive for the markets. There has been this uncertainty there, even while the market has been factoring in Biden presidency, but this sort of uncertainty was lingering there. Now there's some clarity. Markets are expecting the Biden administration, the incoming administration rather, to get going, hit the ground running, and start planning for how to deal with the more pressing issues like the COVID-19 vaccine rollout.
Thank you very much, Ashutosh. Well, we'll keep following those developments there, and I'm sure we'll have more time to talk about that tomorrow. Meanwhile, stocks in London also opened higher. Travel stocks, energy companies, and hospitality firms are leading the charge as investors rotate into hard-hit sectors who should do better when vaccine rollouts allow economies to reopen. Juliana will wrap up the intraday numbers for us. Hello, Juliana. Good afternoon. Well, markets are responding positively to the vaccine news and, of course, the latest development in the U.S. Some sectors are benefiting now a lot more than others. Bring us up to speed with the intraday market numbers and, of course, any other important information out there in London you think we need to know.
Well, Well, the FTSE is doing pretty well at intraday. On the all-share, there are triple-digit gains. I think the oil market is doing particularly well ahead of the OPEC Plus meeting next week, and that's really because for once and for the first time in however many months, they can finally see an end to the death and destruction, which has been the overarching theme of COVID-19. BP, their shares are up about 6.6% at intraday. We've also had an announcement overnight by the Grant Sharps. He is the Transport Secretary here from December the 15th. Potentially, if you test negative from a COVID test, your self-isolation period will decrease from 14 days to 5 days. And this is the run-up to Christmas. And the political theme of today is what happens after lockdown in Britain. We'll be coming out of the national lockdown, the national English lockdown, next week, Wednesday. And there are lots of discussions about which regions are going to be going into tiered restrictions. Big divide between the north and the south at the moment. So at intraday, the all-share is up 1.11%. The FTSE 100 is up by 0.82%. And the FTSE 250, the domestic market, that's up by 0.92%. On the currencies market, the British pound up on the US dollar by 0.35%, down on the euro by 0.03%, and slightly up on the Japanese yen by 0.01%. Chime.
Well, Juliana, I'll let you go now. We have to follow what the central bank is doing today here in Nigeria. They are meeting right away as we talk in Abuja. So we hope to talk to you tomorrow. Meanwhile, following aggressive interest rate cuts when coronavirus restrictions shut down output, African central bankers meeting for the final time this year may have found that they've exhausted their monetary policy options. Activity has improved across as economies reopen, but for economists, balancing the threat of resurgent infections against the inflation that's on the rise means most policymakers in the region will probably hold rates as they seek to support economic growth. That's as fiscal space remains limited and relatively depressed commodity prices continue to weigh on exporters. A lot of them are meeting this week. Let's look at the expectations from some of them and what some of them have done. Okay, the Monetary Policy Committee of the South African Reserve Bank, of course, met on Friday, November 19, and decided to keep rates unchanged at 3.5%. The rate was cut by 25 basis points in January, 100 basis points in March and April, 50 basis points in May, 25 basis points in July, and left unchanged in September, and now it's also unchanged. South African Monetary Policy Committee will meet again on 21st of January 2021. Let's look at Kenya. Kenya Central Bank, MPC, is scheduled to meet November 26 and is expected to keep its rate unchanged at 7% for a fifth straight meeting, even as price growth is seen remaining within its 2.5% to 7.5% target range. Analysts say, of course, after 150 basis points of easing in 2020, the MPC would be reluctant to lower the benchmark, as that could affect risk premiums in new loans and skew access to credit. They maintain that further easing of the policy rate against the backdrop of increased domestic borrowing simply means banks will focus on government securities as opposed to credit mediation to the real sector. Okay, Angola now. Angola Central Bank, of course, hasn't cut its policy rate this year and is unlikely to do so, even as the economy faces a triple shock from the virus, the drop in oil prices and a reduction in crude output to meet OPEC Plus commitments. While inflation is at the highest level in almost 3 years, the MPC is expected to hold the key rate at 15.5% to try to bolster credit growth and economic diversification. The MPC will meet on November 27. Ghana now. The Bank of Ghana, of course, met today. They announced their monetary policy decision today, and they kept their monetary policy rate at an 8-year low of 14.5%. The decision aims to continue supporting economic activity as it waits for the full impact of coronavirus measures to filter through the economy. Meantime, inflation eased for the third consecutive month to 10.1% in October and is expected to return to within the bank's 6 to 10% target by the second quarter of 2021. And here in Nigeria, the MPC meeting started yesterday, and the decision will be announced shortly by the governor. However, analysts say after a surprise 100 basis points interest rate cut in September, Nigeria's central bank will probably leave its benchmark rate on hold as it tries to support growth. Well, I have with me to have this conversation the Director General of Lagos Chamber of Commerce and Industry, Dr. Muda Yusuf. He's here with me in the studio. And of course, I have in our Abuja studio a development economist, Professor Ken Ife there. Thank you very much, Professor, for joining us on the program.
Thank you very much.
And we hope to have an investment analyst joining us shortly in the person of Robert Omotunde. All right, I'll start off with you, Dr. Muda Yusuf. Yeah. Well, I'm sure officially, yes, we are in recession. That didn't come to you as a surprise. Now, there are many issues to consider as it concerns macroeconomic development, looking at the landscape and perspective. So what's your broad-based assessment of Nigeria's macroeconomic terrain amid this COVID-19?
Well, first, let me start by commending the Central Bank of Nigeria for the review of the policy on Form M and the payment through intermediaries and agents. You know, at the last time we had this discussion, we alluded to the fact that this was creating a lot of problems within the investing community, particularly the SMEs. So we are happy that that policy has since been modified and is now a lot more investment friendly. Secondly, let me also say that we have almost excessive liquidity now in the financial system. You know, it is good news to some. It is not so good news to some others. I say this because we have seen a situation. Who is
benefiting and who is losing?
Yeah. The segment benefiting from this are the investors in the real sector of the economy, which is one of the key objectives that the CBN seeks to achieve. We are getting to a point now where prime lending rate is approaching a single-digit threshold, which is good for investment. We are also beginning to see a kind of resurgence or coming on board of corporate bonds, even as low as 6 to 7%. A lot of people are ready to invest in it. That is good. We also see what is happening even to equities. So there is a movement of resources or a shift of focus of investment from just investing in purely financial instruments to investing in the real economy. And this is very good, at least for the objective that we want to achieve at the macroeconomic level. We are talking about investment, job creation, economic diversification. This is the way to go. And I must acknowledge the fact that the CBN policy is achieving that objective as far as possible. Although there are arguments on the other side about the fact that real interest rates are now becoming negative. It's affecting investment in bonds, in treasury bills, fixed income, and all of that. Of course, there are concerns along those areas. But if you look at the general objective of, diversifying the economy, of focusing more on the real economy, on economic diversification, developing manufacturing, agriculture, and other areas of investment, I think it's a very good development. Because we are getting to a point now where even funds from the commercial banks are becoming cheaper than the intervention funds. I just spoke to one of my members before coming here. He said the funds he got from some of these development banks, he's thinking of returning the funds because he's now getting cheaper funds from the commercial banks. So we are beginning to see a very strong interface between the commercial banks and the real economy. Unlike what we were seeing before when practically all the funds were going to treasury bills, to federal government bonds, to all sorts of things. So it's a good impact that this is having on the economy as far as.
Well, coming from you as someone who is always advocating for businesses, I take it as a plus for the central bank.
It is.
Well, Professor Ife, I'll come to you shortly. We'll take a break and then we'll come back and continue this conversation. Welcome back, and this is the special edition of Business Incorporated, and we're looking at the decision of the Monetary Policy Committee meeting today. And I still have here Dr. Muda Yusuf, the Director General of Lagos Chamber of Commerce and Industry, and there in Abuja, I have a development economist, Professor Ken Ife. Thank you both for being with me on this show. Professor Ife, now to you, African central banks, including Nigeria, maintain that they still target inflation. But it is clear that the focus this year has shifted firmly to growth. In Nigeria, naira depreciation and rising costs suggest upside risks to inflation forecasts. Now we are in a recession. What do you think the MPC will do now? Do you think they have exhausted the monetary policy options they have?
Yeah, I think, first of all, let me agree with Dr. Yusuf, because he's quite right that we ought to appreciate the central bank for what it has done and how it has religiously worked on the marching orders from Economic Recovery and Growth Plan, which wanted a significant shift of resources to the private sector and by implication the real sector. He has done that by a variety of ways. It used so many instruments at his disposal. The loan-to-deposit ratio pushed up to 60-65%. Then even asking the banks to come in and take their cash reserve ratio, which is earning zero interest for them, over 4 trillion sitting with commercial central bank, gave it out to the real sector on a medium-term basis of 7 years and some moratorium at 9%, just to start focusing resources. Because in the end of the day, there's so much you can do with intervention, development intervention funds. You need to get money from the market. The banks, commercial banks, need to wake up to the idea that they have to lend to the market. So it's very important that we push those corners. And then also quantitatively, they have intervened in the context of promoting sustainable economic development by targeting resources to presidential value chains that are already experiencing market failures. For example, the food sector or agriculture sector have experienced massive market failure in terms of accessing finance and then the excessive import of these items have undermined the foreign exchange that we have. And you know that we are over dependent on oil for 90% of our forex. So that is double palaver for us. So in the way in which it has focused resources by end-to-end intervention and using the types of anchor borrowers that connects to subsistence farmers, meeting them at their point of needs and then integrating them into national and global supply chain is great stuff. So we want to do more. But then in terms of inflation, I think we're in a very difficult time, because when you look at the type of recession that we have entered into, it's a very strange one, which is aptly described as stagflation. Normally, in a normal recession, you would expect slowdown of economic activities. That means output could decline. When output declines, you have people forced out of into unemployment. Their purchasing power is diminished, so consumption in the economy is reduced. And then people are scared to invest their money in productive activities because they don't know which way the recession would go. So all of those will bring, and then you find interest rates going down because there's less demand for the capital. Then you have also inflation trending down. But here you have them running in the opposite direction. You have inflation galloping in the opposite direction. But then, so the question is, how much scope do we have for monetary policy response? To be honest with you, I don't think monetary policy can do much at this particular moment, because there's excess liquidity in the system. When and this conscious effort was being made, even within the plan, it was intended that the public sector, the treasury bills, which we are offering very high rates at 18%, going down to 14%, should go down as much as possible, because it was causing diversion of funds from the commercial banks and all that. So there was big competition, and it was crowding out private sector investment. So, but now, look at what has happened. Government's intervention in that market is declining. The yield is going down, and then the quantity required is also going down. For 3 months, 6 months, and 1 year, Treasury bill yield is less than 1%. But then, if you are going for 10 years, yeah, you can head up to 3.6%. If you are going for 30 years, 10%. So that is a good place to be. Now, what then happens is that with also the central bank kicking out the private sector, domestic private sector from the open market operation, actually meant more liquidity in the private sector. And then with all this yield trending down, it is big opportunity for blue chip companies to issue more bonds, corporate bonds, and their commercial papers at, in fact, even lower rates. So you see them doing it at 5%, which is good news. So there is a mitigated flow of capital now to the private sector, especially the real sector of the economy. This is where we have to focus if we really mean to diversify the economy away from monocultural dependence. That is where we need to focus if we really mean to create employment and sustain the employment, and then make sure that other sectors that can contribute ultimately to diversifying the forex base does get a look in. So I think we're heading. We have so many headwinds, and there's no one answer. So we have to see what the MPC comes up with. But frankly speaking, I think they should be reducing that MPR rate. To be honest, they should take it down a little bit more. Why? Because high interest rates, high MPR rates, tended to focus on attracting foreign direct investment, attracting foreign portfolio investment, and the likes. But they're not there. 4 years, 5, we haven't seen the FDI. It's gone. Then the portfolio investment is also vaporized away.
Right.
And the reason is this.
Professor,
people are having excess liquidity here.
Professor,
and they wondering what to do with it.
Professor, we will have a lot of time to talk about this. We'll just have to leave it now. We will come back when we will still talk about what the MPC is going to do. We'll come back at the nick of time. That is 2 p.m. as we await the decision announcement by the central bank. For now, that's it on Business Incorporated Special. I'm Chimeze Obi Iwago.